In this video, we are gonna explore how Rule of 40 gives a snapshot of a stock's future alongside some case studies, and at the end of this video, a couple of promising stocks by the standards of Rule of 40 will be presented and analyzed. The Rule of 40 is a financial metric used by investors to evaluate the financial health and growth potential of a company, especially those high-growth ones. The rule states that a company's revenue growth rate and profit margin should add up to at least 40%. The formula for the Rule of 40 is as follows. Revenue growth rate plus profit margin equals Rule of 40. For example, if a company's revenue growth rate is 30%, its profit margin should be at least 10% to meet the Rule of 40. The revenue growth rate is the percentage increase in a company's revenue from one period to the next. The profit margin is the percentage of revenue that is left over after deducting all expenses, including taxes, interest, and other costs. There are a couple of variants of profit margin that will be covered later on. By using the Rule of 40, investors can identify companies that have a healthy balance of growth and profitability, which may indicate a strong potential for long-term success. Investors use the Rule of 40 to evaluate growth companies because it provides an overall view of a company's financial health and outlook. A company with a high revenue growth rate could offset its low or even negative profit margin for a while, expecting the profitability to catch up in the near future when the growth rate slows down. On the other hand, a mature company with a high profit margin but a low revenue growth rate may also be a rewarding company that keeps returning profits back to the shareholders in one way or another. There are three main variants of profit margin used in the calculation of the Rule of 40. The first one is EBITDA margin. This variant of profit margin is calculated by dividing earnings before interest, taxes, depreciation and amortization, EBITDA, by total revenue. It is commonly used in the technology sector and for companies that have high depreciation and amortization expenses. While it is straightforward and could be easily obtained from the income statement, EBITDA does not take into account the impact of interest payments, taxes, and non-cash expenses like stock-based compensation, which are important factors in determining a company's profitability. In EBITDA can be easily manipulated by companies to make their financial performance look better than it actually is. The second one is net profit margin. This variant of profit margin is calculated by dividing net income by total revenue. It is a more comprehensive measure of a company's profitability, as it takes into account all expenses, including interest payments, taxes, and non-cash expenses. It may not be applicable to companies that are in the early stages of growth and are reinvesting most of their profits back into the business. The free cash flow variant of the Rule of 40 is a variation of the standard Rule of 40 that incorporates a company's free cash flow instead of its profit margin. Free cash flow is the cash generated by a company after accounting for capital expenditures required to maintain its current level of operations. It is a measure of a company's ability to generate cash from its operations and is often used by investors to assess a company's financial health and sustainability. The free cash flow Rule of 40 takes into account a company's ability to generate cash from its operations while also maintaining its growth trajectory. This metric is particularly useful for companies that are reinvesting heavily in their operations to drive future growth. Since according to this research by Morgan Stanley, combined 80% of the success of an investment of 10 years in a company comes from revenue growth and free cash flow, the survival of a company solely depends on the cash flow, and free cash flow is also the least possible to be camouflaged. The free cash flow version of Rule of 40 is opted for. Rule of 40 is flexible in spotting the potential of a successful company in its early days, whether being a high growth rate along with a thin or even negative free cash flow margin, balanced growth and profitability, or a high free cash flow margin with limited growth opportunities. Some examples will be presented to illustrate the magic power of Rule of 40 for each type. One example of a balanced Rule of 40 leading to an impressive 60-fold in 13 years is FT&T. Fortinet Incorporated is a leading provider of cybersecurity solutions that help organizations protect their networks, endpoints, and cloud environments from cyber threats. The company was founded in 2000 and is headquartered in Sunnyvale, California. Fortinet offers a wide range of cybersecurity products and services to customers around the world, including firewalls, intrusion prevention systems, endpoint protection, cloud security, and more. The company's products and services are designed to help organizations of all sizes and industries defend against cyber attacks, data breaches, and other security threats. Since its early years as a public company, FT&T has been demonstrating a balanced score of Rule of 40, i.e., almost even contribution of growth and free cash flow and little fluctuation around the average score of 50. Another example of a cash cow with a score of Rule of 40 above 40 is Adobe. Adobe Incorporated is a multinational software company that leads the digital media and marketing industry. Its flagship products, including Photoshop and Creative Cloud, have a loyal customer base, and it has been expanding into the digital marketing space. For the past decade, Adobe offers a stable investment performance of 20-fold with more profitability than growth. A vivid example of the transition from a high-growth company with little free cash flow to a more balanced compounder is PayYC. Paycom Software is a leading provider of cloud-based human capital management software solutions for businesses of all sizes. Paycom's software platform helps businesses manage their HR functions, including payroll, benefits, time and attendance, talent acquisition, and management, all in one place. The platform also offers employee self-service capabilities that allow employees to manage their own HR information and documents. Almost 10 years ago, the company was young and small but growing rapidly, generating little free cash flow. Subsequently, the company grew so healthy by gradually turning its portion of growth opportunities into a significant free cash flow margin and has become a typical balanced Rule of 40 company. The last example is an exciting and dramatic demonstration of a turnaround from an extreme qualifier of Rule of 40 to a more sustainable and potential winner of Rule of 40. Shockwave Medical, Incorporated, SWAV, is a medical device company that develops and commercializes products intended to treat calcified plaque in patients with cardiovascular disease. The company's portfolio includes intravascular lithotripsy, IVL, systems that use sonic pressure waves to fracture calcium within arterial blockages. This technology aims to facilitate the delivery of stents and other therapies to previously challenging treatment areas. SWAV has experienced significant growth since its inception in 2009. The company went public in March 2019, when the company had negative free cash flow due to significant investments in research and development, as well as capital expenditures related to expanding its manufacturing capabilities and commercial operations. However, the company's strong revenue growth and improving gross margins have allowed the company to generate positive free cash flow in 2022. This is a positive indicator of the company's financial health and ability to generate cash in the future, and also has helped the stock price achieve more than 10-fold within 3 years. Alright. All of the examples we have covered so far are in hindsight. Are there any current opportunities where the Rule of 40 can be applied? Let's take a brief look at 2 companies whose charts of Rule of 40 are as shining as those of the examples in the early years. Hims & Hers, HMS, is a healthcare company that was founded in 2017 with the aim of providing accessible and affordable healthcare to people across the United States. The company's business model is centered around telemedicine, which allows patients to consult with doctors and receive medical advice remotely via smartphones or computers. Hims & Hers offers a range of products and services, including treatments for hair loss, erectile dysfunction, birth control, skin care, and mental health. The company's products are sold online and are available without a prescription in most cases. Hims & Hers has also established partnerships with major health insurance providers to offer coverage for its products and services. Since its inception, Hims & Hers has experienced rapid growth and has expanded its product offerings to include additional healthcare services. In 2019, the company acquired telehealth provider Apostrophe, which added prescription skincare and acne treatment to its product lineup. In 2020, Hims and Hers went public through a merger with Special Purpose Acquisition Company, SPAC, Oaktree Acquisition Corporation. Since the merger, the company has continued to expand its product offerings and has launched several new services, including virtual primary care and mental health services. Despite the company's success, Hims and Hers has faced headwinds in 2022 due to increased scrutiny from regulators and lawmakers. The company has been criticized for its marketing practices, which some have argued are misleading and target vulnerable populations. In addition, Hims and Hers has faced legal challenges related to its prescription practices and has been required to pay fines and settlements. Looking ahead to 2023, Hims and Hers is expected to continue to expand its product offerings and pursue partnerships with healthcare providers and insurers. However, the company will also need to navigate regulatory challenges and address concerns related to its marketing practices in order to maintain its growth trajectory. Tecnoglass is a Colombian company that manufactures and sells architectural glass, windows, and aluminum products. The company was founded in 1984 and initially struggled to establish itself in the highly competitive industry. In the early years, Tecnoglass faced numerous challenges, including financial difficulties, poor management decisions and a short report by Hindenburg Research. However, in recent years, Tecnoglass has experienced a significant turnaround and has emerged as a leading player in the industry. One of the key factors behind the company's success has been its strategic focus on innovation and technology. Tecnoglass has invested heavily in research and development, which has enabled it to develop new and innovative products that meet the evolving needs of its customers. Another factor behind Tecnoglass's turnaround has been its focus on international expansion. The company has been successful in expanding its operations beyond its home market in Colombia and has established a strong presence in the United States and other key markets. This has helped to diversify its revenue streams and reduce its reliance on any single market. Tecnoglass's financial performance has also improved significantly in recent years, and the company has been a qualifier for Rule of 40 in 2021. For recent quarters, the company has been showing more and more characteristics of a balanced Rule of 40 player tilted a little bit toward growth.